To deliberate on this topic, we have an eminent panel today, and please put your hands together as I'd like to call on stage the moderator of this session, Kalpen Parekh, who is the CEO of IDFC AMC. Joining him is Anant Gupta, Director with EY's Financial Services Practice in India. Anant is a part of the advisory practice specializing in the financial services at EY. Also welcome Omkeshwar Singh, who is the head of mutual funds at BSE. Joining them is Rahul Parekh, who is the head of Aditya Birla Money My Universe. He's played a key role in building the robo-advisory My Universe platform. Please welcome Ravinath Dasika, co-founder of Tavaga, which is the new age robo-advisory platform. We also have Vineet Arora, who is the head of products and distribution at ICICI Securities. Under his leadership, ICICI Direct platform has won numerous awards for offering their cutting-edge technology and convenience to investors. Thank you.
Good afternoon, everyone. Very big audience, and I hope to have a very interesting 40-minute conversation on something which is a very favorable, fashionable topic and conversation. So I want to start off with the first comment and question, which is open to all of you on the panel. In '99, .com was important to have in the name to get valuations. Today, robo before the name has become very important to have. And in the last quarter alone, I've read somewhere that 60 new robo-advisors have registered and are talking to fintech companies. So food tech was the trend in the last few quarters. Fintech is the new trend currently. So Vineet, you set up, ICICI Direct has been there for the last 16 years. So in fact, the original robo-advisor of India. I want you to kickstart the conversation.
Thank you, Kalpen. I'll just break your question into a couple of parts and then take it from there. One is that, is it a trend, is it a fashion, or is it, really adding value to the business, or is it a disruption on the existing model? I think it's a bit of both, and it does end up adding value through, able to compute and do so many other things. But, how do you really present it to the client? How do you really, bring it in, and does it really, is going to disrupt it today with the, the clients coming in and doing their own advisory? There I have my elements of doubt, and maybe during the panel discussion we can, see more of it. From an experience of ICICI Direct, when we set up ICICI Direct, also there was a saying, this won't work. The way to, do broking, the way to do share trading is always offline. You need somebody in front. But the way it picked up was a case study in itself, and it has picked up dramatically well. We understand some bit of clients who are doing online stuff, and that's where we also have our own version of robo-advisory. I call it a version of robo-advisory because we don't do a front-end client interaction robo-advisory on our platform. What we do is that once the advice plan, etc., is developed and made, the entire tracking and the acting on the plan is all automated and is all on the platform like that. So it's a version which is, I would say, the back end is completely robo, but the front-end interface we've still kept it very human. And we believe, it's going to be still some more time before, we can look at and automate it on the front end as well.
Rahul, your comments?
I think the real question is about what is the problem that robo-advisory is solving. And to my mind, I think there are three problems that robo-advisory is solving. Number one, there is a big access challenge in this country. And I think robo-advisors are leading that pack in terms of reaching out to underserved masses, typically your millennials and Generation X, which is not served by your traditional distribution channels. Number two is that I think there's a need for better advisory and transparency. And I think that's something that robo-advisory does very well. And I think number three, and the most important thing is that the cost of access needs to drastically come down, which is very high if you go beyond the top markets. And I think that's again something that robo-advisory does well. So to my mind, robo-advisory is something that solves three critical problems of an underserved market, and I think it's here to stay.
Ravi, you are a latest entrant in this space, and some of us have been in this industry for 16 years. When we started our careers, penetration was around 6%. That number hasn't changed much, so we were very enamored by the opportunity. Welcome to the gang. What's the thought that brought you in?
Thank you. It's a great pleasure, and I thank you for the opportunity to be here. Going back to the example that you started with, although we refer to the dot-com as a bubble today, most of the technology giants that exist today were born during that time. So there is going to be a lot of noise when a systemic change is happening. That does not mean that there is no change happening, that it is just a fad, that it's going to disappear. The way that your Googles and Amazons and everyone emerged during the dot-com bubble, the same thing is going to happen. There'll be a few really good players who will make an impact, who will change the way technology plays a part in. Now, robo-advisory itself is a fancy term. We like creating these words, buzzwords that can be used by everyone in the media to kind of further their own cause, mostly. But the changes that are happening today are, I agree mostly with Rahul. The two things that are definitely happening is inefficiencies are being driven out by robo-advisors, especially on the advisor side, maybe not the client side yet. It'll get to that with time. The second thing is there are some people who are at least trying to bring in some objectivity into it. So move away from a regular mutual fund structure where there is no clarity in terms of what is happening behind the sale is something that people selling direct mutual funds or people like us who are trying to get into ETFs are trying to do as well. So these are the two things that are being addressed right now. There are about another half a dozen problems, which time will decide how it kind of evolves and solves. So from a customer perspective, the only idea that has just started to emerge, even in the West, is goal-based investing, which you can consider a subset of robo-investing, because I really haven't seen any traditional players making a serious pitch to link investments to goals.
So I'll stick to the left-hand side of the panel before we move on to the next question. What I want to know, Rahul, you highlighted that there are few problems that one is trying to resolve. So in a way, you're right that technology will help you reach out to more people. But how do you contextualize the fact that two realities? One, India as a country, while has a higher population, but has a much lower per capita. So investable surpluses are low. And second, technology here and in global other developed countries is not really comparable. So do you see the access part being really reaching it to the last mile? Any challenges that you see on that front?
Sure. So I think pretty much your question answers the entire thing. In my view, I think any market like India, which is a fragmented market, has low disposable income per capita basis, is best served by technology because the physical cost of reaching out is going to be humongous, and what that would mean is that you would never reach out to that base. So in my view, I think technology is the way that you can reach out to this audience, because the incremental cost of reaching out to one more person in technology is just marginal. So I think in that way, technology is the right solution for reaching out to masses and increasing the penetration. Yes, there are some problems if you look at India as compared to US or other markets like China, because the infrastructure is yet not evolved. But I think in my own experience in the last 2 years, there's been a rapid evolvement of infrastructure. I mean, anybody who has tried the Reliance 4G will vouch for the kind of speeds that we are talking about. I mean, I'm ashamed about my Wi-Fi speed at home after using Reliance 4G. So I think if that's the trend of things to come, then I think India will be on a high path to adopting internet technologies. The second thing is, I think the digital infrastructure is already kind of shaping up, with NPCI coming up with things like e-sign process, to make it completely paperless, or for example, the central KYC initiative, or for example, Aadhaar-based KYC. I think these are all steps in the right direction to ensure that there is a seamless KYC and payment process which will allow digital enablement. And last but not the least, let's not even forget regulators. I think they are trusting heavily on transparency, awareness, and digital enablement. So I think that will create a pent-up demand in a large section of population. All mutual funds spending 2 basis points creates a corpus of 250, 300 crores of awareness creation. Now, if this demand is not served, then I think this pent-up demand will find its way in some way or the other. And today, I don't see the physical distribution yet reaching out to this demand base. So the only option for them is to use online channels to kind of access mutual funds and other products. In that sense, I see that yes, there are immediate short-term bottlenecks in the technology from a point of view of the infrastructure, but I think eventually it will kind of pan out in the next 5 to 10 years. If you take a longer-term view, I think it looks great.
Anand, your comments on what Rahul mentioned, that reaching out to investors with lower ticket sizes is very expensive. As a consultant to this entire space, how do you see the costs and the opportunities? Because what we keep hearing is the cost of acquisition itself is very high. It is unlikely that people would make money on this cost of acquisition.
So, Kalpin, I think there are 2 or 3 perspectives to look at here. One is, as Rahul mentioned, that the cost, the opportunity definitely exists in terms of having a large base. As per the recent, if you look at the numbers, there are about, if you look at the households with more than 5 lakh of income in India, there are more than 6 crore households that essentially can be tapped onto through this platform. So from a perspective of profitability or viability of this entire model, the crux is that the cost of investment into this model is fixed, right? And then essentially it is about trying to arrive at the right price points and making them viable with more volume. Ravi also mentioned the fact, I think, then like each and every trend that has happened, whether it be e-commerce, whether it be food tailing, as you rightly mentioned, there are a few players that will survive, and those few players will definitely get profitable with the right volumes. Just taking a parallel example from from let's say the small finance bank space or the payment bank space that is being opened up by RBI right now. There also the people who will survive are the ones who are able to make the economics work at the grassroots level. Profitability at an individual customer level will be extremely low, but at aggregate level is what we can hope to push up.
So recently I read some data points that globally the 2 or 3 large robo-advisors are people like Betterment or Wealthfront, and they've acquired size to the extent of $3 billion USD. Now 3 billion is actually nothing. A lot of banks here in India or distribution platforms have a bigger size or 2 times larger size, and the revenue that they've generated is around 7 to 8 million. So that comes to 23 basis point. My question to you guys is, in India, 100 to 125 basis point of revenues also seem low, and that has been the debate in the last couple of years. And in international markets where the size and the pools are much larger, margins are much, much lesser. So how do you make your plans, assuming you're not talking to your investors who are funding your platforms, very candidly, what gives you hope?
So I think number one, this fancy of comparing with US and Chinese market, I think once and for all we should drop it, because our markets are not strictly comparable. Typically the kind of margins that we're talking about in the US market is again not comparable, because let's look at whom are we fighting against. In my view, India is an under-penetrated market as compared to US, which is highly penetrated. So the real fight is against the spread of a deposit or spread of a savings bank account, and not really against a comparable mutual fund or ETF being offered by a comparable fund house. So in that sense, I think there is a huge category penetration which is left over there, and I think till the time category penetrations are low, in my view, the margins will always remain on the table. So I think that's the first part of it. The second part is that ultimately if you look at the business from a point of view of a customer, it really doesn't matter how much money you make on one single product, provided you are willing to stay put through the lifetime value of that customer by ensuring that your platform serves all the needs of the customer and not just one need of the customer. And there are multiple ways in which you can monetize that. In my personal view, I think the products will become less relevant over a period of time, and the bigger part of the monetization will come from the data and analytics. Time will tell, but I am strongly of the opinion that data and analytics will be the bigger driver of monetization for the internet models, then strictly speaking, the product-based commissions.
Can you elaborate a bit on that, data and analytics? How will really it make a difference to the life of the customer?
So just a simple thing like, for example, a lot of us in this room will be using credit cards, right? Now, we are, most of the times using credit cards, using what credit cards we have bought and what we are habituated about. But if you actually go to see, for every spend that you do, there is a certain credit card which works best for you, depending on the kind of, discounts you make on it, depending on the kind of loyalty points that you make on it, and depending on the kind of, other benefits that you cash back and other things that you get on it. Now, the point is nobody evaluates that while doing the spend decision. Now, imagine a situation where you have this data of customers and you are able to tell the customer which is the best card. The card acquirer will pay you a pot of gold for getting that kind of customer, because based on your spend analytics, you are able to tell the card provider that this is the right kind of card for the customer. So the customer is happy that he is getting the right card based on his spend analytics, and the card acquirer is happy that he is getting the right customer. Now, that kind of matchmaking when you do using data on your platform, I think you can create serious amount of value.
Vineet, my question to you is context in the first question, that is robo-advisory really making the role of the distribution, which is already existing, more productive by becoming digital, or is it really changing the life of the consumer? So looking at it, does it change anything for the customer, or it changes more for the advisors?
It impacts both, and to answer this question, I will touch a little bit on the infrastructure part that you were talking also. So, for any kind of a new business or new channel like this to be successful, there are 3-4 key elements which have to fall in place, and then, only you can see the entire cyclical change coming in place. So one is the infrastructure, one is about, digital penetration, where I think we are fairly moving, and all of us are confident that someday, maybe a couple of years down the line, we'll be, really relatively good. Where I still have an element of doubt, and which I think will take a little longer, is the behavior and the propensity of the customer to come into a product like, mutual funds. Is where I feel that, it's a product which today is still a low involvement product for the client. And so a lot of education, a lot of work has to happen there, and it will be a longer and a more painful process. I'm not saying it will not happen, I'm just saying it's going to be longer and more painful process. We'll need a lot more of investment to get into that entire process, where the investors become more aware. It's also an issue of what alternates does he have available. So, when you have fixed incomes giving about 8% return, and your equity markets, you say in the long run give you 10-12% returns, it's not such a big incentive for him to, there is not such a pull that is getting generated. And hence, a face-to-face person who comes in, talks about long-term advantage, explains the entire concept, is still very critical. And this could change. I'm saying this could change, but that's still very critical. So the robo-advising in the current form, the way I see it benefiting the advisors much more than I see it benefiting customers in the current form. Why? Because, as an advisor now, so what actually a robo brings in is that, it brings in the ability for you to standardize your output, run multiple scenarios on a typical, client requirement, profile him, run typical scenarios. If there is a goal-based requirement, it can, find out so many methods to reach that particular goal, draw out a plan which is, best suitable for him, and then periodic reviews can also happen using these tools. So I think as a tool, it is going to be much more accepted in the beginning. And as advisors, we will have to move into that concept, because the clients will start expecting you to come out with an output which is much more standardized and this thing. Gradually, maybe once the learning, etc., picks up, then they might say that, I want to now check it out directly. So I believe, I'm on that side where it's saying that it's a very gradual process. It will take longer to happen than what we think is going to happen. It's not going to be a 1 year disruption. It might take much longer for it to reach there.
So Vineet, you brought a very interesting point that there's a huge opportunity for advisors to digitize first before you make customers digitize. So in that context, Omkar, your firm is working on building a platform, which is a B2B platform. Right. So how do you see the opportunity, and how do you see advisors finding value in it?
See, right now, as an exchange, we see that It's an infrastructure marketplace, and we see that there is no penetration happening. Riskier products have been introduced onto the exchanges. It hasn't got the clientele. Similarly, now it is moving towards investment products. Mutual fund is one of such products. That is where the focus has been for the BSE. Now, how do you look upon it? Is that this robo-advisory can be an enabler. How it can be an enabler is that the technology, that every advisor has self-serving customer and a customer who needs you to be there in front of you. So anybody who is comfortable serving himself, those are the type of people you will be able to provide the robo-advisory to begin with. And people who want you to meet and do, there you can go and give the advice. Similarly, this robo-advisory also gives you the opportunity to reach on every smartphone. Now, if it is available on every smartphone, then you are increasing your reach. The probability that the penetration of mutual fund will increases. Now, seeing all this, what we have done is we have created an infrastructure, and we are continuously upgrading the infrastructure. So it becomes a super highway, which can be accessed by anybody from the biggest to the smallest, will have the same technology infrastructure. So that the physical cost which we were talking about, the cost which is required for anybody to go and get a customer on a physical basis, that is reduced. And this platform is an open platform which is available to everybody. So this is how BSE has been trying to play this game.
Ravi, do you agree with all these comments?
I have a slightly different view. I think this is where you'll see the difference between a traditional player and how some of the new emerging startups think. So we've heard a lot about returns and anchoring to a particular value being greater than a FD rate, things like that. To be honest, I think what we are trying to do, and I think a lot of other people will definitely catch up with that and do the same thing very soon, is that the anchoring is completely wrong. The way things are being sold, irrespective of there is a robo behind it helping the advisor or the customer or whatever, if the sales is based on what happened in the past, you're giving the customer a very wrong anchor. You're pinning him to the 20-25% return or whatever was produced the last year. That's when typically a retail customer comes in. The whole cycle that we are talking about, that retail only comes in at the wrong time and leaves and it's highly cyclical, is because of the anchors that all of us are creating for them. So one of the things that we are doing, and I know for sure that there are at least another half a dozen people who are doing the same thing, is shifting this anchor from investments and returns to goals. The goal parameters should be the anchors. How far is my goal? What is the size of the goal? What do I need to contribute to get to that goal? Once this shift happens, there is a huge change in the behavior of the investor itself. So when we talk to younger people between 25 and 35, this is a very easy sell for us. While we talk to people who are 40 or above, the problem is that traditional players have already anchored them to percentage returns. The first question they ask is, what is the return that you're going to give me? Once that shift happens, cyclicality goes away, that's when the robo starts working for the customer. Right now we are at a stage where it is working for the advisor. What BSE is doing, what ICICI is doing, what MyUniverse is doing, is helping the advisor. All of that is already automated, and if there is someone who hasn't done it, they'll do it within the next year or two. However, for the robo to work for the customer, we need to really get to a point where the entry barrier for the customer is lowered by the robo. So we don't need to educate the customer about the products, the returns, and things like that. So if you ask me what we are selling goals. We are not selling ETFs, we are not selling mutual funds. What we are selling is a goal and how to get to that goal.
So I just want to stress a bit more on that. My observation has been the industry has digitized in the last few years and brought in technology to do fund selection and try to eliminate human bias of fund selection. They've built algorithms and models to design model portfolios, which are then evaluated. So perhaps every platform says that I have my unique algorithm. So there are thousands of unique algorithms which eventually give the same return. So in that construct, how do you look at innovation on that side?
That's a very good question. So first thing, just addressing what is happening today. Yes, everyone says that we have the best algorithm to pick the best funds. So that's a game that the US robo-advisors never got into. And we are one of the people who are not getting into that. That's the reason we sell ETFs, because we don't believe in picking the right fund. However, there is some additional return that you can add by a good asset allocation algorithm, which really depends on the customer, not really on the markets. All we are looking for is a good diversification benefit. In terms of how this will evolve in the future, I think there's going to be a lot of action actually on the product front, where you are, not where we are. That's where the actual robo will emerge from. It will not come from the distributors and sellers. It will come from the people who are creating the product. Right now, it looks like goal-based investing is going to be in fashion for the next year or two. Everyone will launch a platform. We'll link your financial goals to certain products. There's no direct link between them. If you want to send your kid to the US for education, there's no real product that serves that need. However, we'll package it in some way. Right now, it's a combination of either mutual funds or ETFs which are serving it. Probably in a year or two, we'll see fund-of-fund structures which are much more aligned with it. But the future really is actually creating products that link to customer goals. Right now, the products available in the market are driven by the companies. There is a company which issues stock, there is a company which issues a bond. Then we repackage them based on the size of the company, the nature of the company. It's driven by the producer of the asset, not the buyer of the asset. We'll see a shift from that end to the other end, where the product that is being sold is in line with the customer's goals, the buyer. So if I go out and want to buy a laptop, I choose what I want. I don't necessarily go by what the producer decides I want. The same kind of shift will happen within finance also. It will take some time, probably 5 to 10 years. This is already kind of in the works, at least in theory in the US. So we'll see things like college bonds coming out, 20-year bond. You know, if you have a kid who will go to college in 20 years, you'll just invest money regularly into one particular bond, which will give you the exact amount of money that you need to put your kid through that particular college. So such innovation is kind of happening. It's at a very nascent stage, but once that happens is when we see a massive shift in this whole industry. And it will be driven by your side, not by the people selling it.
Giving me a lot of food for thought. Vineet, I heard, it's slightly unusual to hear of someone saying that our product selection will be driven through ETFs, because they've not been very popular yet, both from the manufacturing side, consumer side, as well as distribution or advice. And perhaps one of the reasons is that they are not very remunerative. So where do you see that trend? Do you see a few years from now focus moving more towards lower cost intermediation and ETFs? And in that context, how do existing platforms or channels make themselves ready?
Focus moving towards lower cost, the answer is yes. And I think it's not just the consumer going to demand lower cost, it's even the regulator which is pushing to move towards lower cost. So either it's through a direct mode or through a ETF mode, whatever. The push of the system seems to be that you have to move towards a lower cost, and that will eventually happen. You could delay it, but it will eventually happen. Whether the best way to do it is through a direct fund or through a ETF route, that is on the maturity of the market, is what I would say. So ETFs are today at a nascent state, but they're building up with a lot of institutions now putting in their money. So challenge of ETF so far has been liquidity, so far has been the spreads which are there on the market. So, you might save on the cost of fund management, but the moment you go to sell an ETF in the market, you kind of just give away what you saved on the cost of management. So till the time that, it's like a chicken and egg situation. So by the time that really falls in place, your ETFs might not become as popular. Second thing is the index which you track ETFs are not as, so let's say, you do a Nifty ETF or you do a Sensex, they're fairly concentrated indexes. So they're not really, so if an index is moving, a large blue chip segment is moving, then it's fair. But otherwise, trying to get into a mid-cap kind of ETF, etc., you really, really fall down on liquidity. So that's a real challenge with ETFs today, which are direct funds, etc., are able to still, mutual funds are able to go through and give a much higher, alpha over what indices are able to give. And that, I believe, will remain for a few more years till the time markets reach to a much deeper liquidity and more volatility. Gradually, cost is going to be important. I think cost will always be important, because if you're not able to give as much return, then cost is the only thing that you will have to save on. Just dwelling on the goal-based point, I think goal-based, I completely agree, is a right way to go in the long run. The challenges that you face with the client when you're doing goal-based is that, they're also not very clear on their goals. So there's a lot of interaction which needs to happen. So we have an advisory unit where it could take really 1 month, 6 meetings for them to completely able to articulate what they want to do. And then, you move in. So a maturity cycle has to go in. It might be a generational shift, might take 5 years, might take 10 years. And education systems have to encourage more of this. Today also in schools, you still talk about fixed deposits, recurring deposits. The only chapter you cover for shares and dividends is about shares and dividends, nothing called mutual funds. Okay, so nothing around fund of funds. So all this has to really catch on to, become much more acceptable product in the market.
So, Rahul, do you see the digital penetration and robo-advisory as a platform encouraging more literacy and being an enabler towards literacy as well, not just from a reach point of view? So reach is the pipeline, but if the literacy is not there, the consumer doesn't know that the pipeline has reached me. So how do you see you playing a role in spreading literacy?
So before answering that, I think I want to put my views on what both my friends over here said. I completely agree with Vineet. I think Indian markets, till the time they see alpha, I don't think the movement towards ETF will be very strong. And we've seen this over the last 4-5 years. So I think that's quite far away. Second thing is, I think with respect to even goal-based, like Vineet said, most people are themselves not evolved about their goals. So I think very difficult to imagine that will pick up. I think the larger point that we are making is that can robo-advisory solve the access problem? And let's look at what are the 3 big problems that are there in our country. It's futile to compare with US market because they are completely different. Number 1, you have the lack of availability of advisors in remote markets. Number 2, you have a situation where even if the advisory is available, that's not the right kind of advisory or the best kind of advisory available. And number 3, most of the time it's not available in the language or the what we call as vernacular stuff that, it's over there. Now look at how robo-advisory can solve this problem. We all have spoken about, we all have kind of experienced a kind of voice bots that today, for example, a Google or, Amazon does, right? Now this will really become a way to kind of reach out to masses. This will really become a way to deliver efficient advisory, the best of the advisory. And let's not forget that the advisory that we can deliver through this is not only the advisory that we as experts do, but there could also be a crowdsourced advisory that you can create and deliver in a very efficient manner using machine learning. And the last bit is about the vernacular part, which today there are enough and more translations available. So you can really efficiently deliver the service to the remote locations in the languages that they want and in the kind of advisory that they want. And I think that is where the big opportunity is there. And if we look at that opportunity, I still believe that, margins will really not be an issue. Serving a blue ocean market, which people are not even going over there. Typically, margins always come under pressure when there is a competition in the market. If you go to a completely blue ocean market, I think it's out over there for you to kind of tap.
I think very interesting point. What you're saying is, first of all, consumers need to know we exist. It doesn't matter which products we sell, but the fact that we can make a difference to them. I mean, that context, when you are starting off with ETFs, there is alpha which is there in the industry. 99% of our industry, which is manufacturers as well as advisors, are going to scream and shout alpha over the last 10, 15, 20 years. In that context, do you think there is space for a model like what you're suggesting?
So firstly, I don't think there is any alpha. It might come as a surprise to a lot of people because there have been, when we started off, we also believed that there is alpha. Once we did a little bit of research, we discovered there is actually zero alpha.
That's very controversial. Why do you say that?
So let me explain that. So what we did is a fairly massive study. We took data from pretty much every possible public website, all these mutual fund aggregator websites. We ran a small analysis. We actually went into the portfolios of the mutual funds. So there are 2 things. First thing is, even a value research compares the performance of a fund to a price return index. Once you add dividends, more than half the funds do not beat the index. The second thing is, what we did is we took 10 years of data. We looked at large cap and mid cap segments. In a large cap fund, you typically find that there are a lot of mid cap stocks as well. So if you combine your large cap index and mid cap in the same ratio, there is no alpha. So if any of you still do not believe me, we have one of our team members right at the back called Madhvi. She has a tablet with the results of the analysis. We have an Android app which will show you. You can name your particular equity mutual fund. It will tell you how it performed versus ETFs. What I can tell you is that there are exactly 15 funds which have beaten a passive index over the last 10 years. Once you account for the biases that are there inside the fund itself. So there is really no alpha. You can use 2 ETFs or 3 ETFs to beat 95% of the mutual funds out there very easily.
That's a very interesting thought to bring a new narrative, which I'm sure a lot of you may want to revisit and challenge this notion that there is no alpha, because our primary USP to our advisors is we will help you in good fund selection and alpha. My last bit to you, Anant. Typically we've seen penetration grow when market cycles do well and the retail investor comes in. Do you think this segment is meant only for middle class and retail investors, or is it also meant for a larger rich audience as well?
So Kalpin, I think there are two parts to the question in my mind. One is the question that you asked before, and which Vineet actually put in terms of, is it robo-advisory or is it robo-assistance? Right. I think there is a bit of both. If I look at if we just look at the customer perspective, the customers, and broadly classify them into served and underserved or unserved, right? There is a large majority of the customers that we speak of is the served customers. There are gaps in what they are being served with today, right? Which is what I think most of the discussion has been around today in terms of, how do we kind of fill those gaps. There is a definite scope for assisted model, right? So there the advisors will continue to play the front-end role, and the gaps will potentially be filled. Gaps can either be in terms of information, in terms of insights, in terms of analysis, in terms of portfolio, rebalancing, the speed of it, etc. Those will be filled by the robotic or digital models, right? Having said that, on the other side, there is a huge market which is the unserved or underserved market, right? Where it does not make economic sense perhaps today for the players in the industry to focus, right? And which is where the large mass is, right? There, I think there is a definite scope for the pure advisor model as well. Whether it be what Ravi was speaking about in terms of goal-based, or whether it is some of the US robo-advisors are beginning to do in terms of customer profiling, risk profiling, asset allocation, etc., and doing the whole hog. There is a lot of innovation that is definitely that definitely will happen. I think we are still in version 1.0. It will take probably version 4.0, 5.0 to actually start to compare the two models in terms of which advisory is better.
Rahul, last bit, I know time out. You've been in funds, you've been in distribution, and now this is the new version. A lot of advisors out here to listen to us. What's your advice in terms of the trends, and is it a threat to the conventional advice business, or is it an opportunity?
I definitely think that it's not a threat. It's an opportunity. I think, in my mind, I think the physical advisory and the robo advisory, I think they are just kind of jargons being used. Whatever is most efficient for the customer is what should serve that customer. So in my mind, I think they're not competition. They can coexist. In fact, in US itself, there are a lot of models where a lot of advisors use technology platform for delivering the service, whereas the advisory and the relationship management aspect is done by the advisors. Typically, models like Personal Capital have been hugely successful in US. So it's up to the advisor to see this as a possible change, because the customers are definitely shifting there, and there is enough and more data to prove that the customers are shifting to online channels. The advisors can also become far more efficient in delivering their advisory and service through online channels. So in my view, I think it should lead to coexistence. And again, I think the larger point that I want to make to this audience, and we were debating about ETFs and actively managed funds. I think, to my mind, that those are again futile debates, because we're not competing between ETF and mutual fund, actively managed mutual fund product. We're competing against a savings account. We're competing against a deposit. Let's go and fight out that market. Let's go and kind of expand the market. Let's go and kind of create category penetration where a large number of people are beating inflation and creating real rate of return where they'll make wealth. I think that's when the customer is really happy. He's not excited by seeing that, this fund is doing better or this ETF is doing better. He's more excited by seeing his money multiplying. And that can only happen if he's beating inflation consistently and if he's into products which are beating inflation consistently. So I think the larger issue to my mind between all of us in this room is to kind of go and do the category penetration and expand the market and not really worry about which product, which ETF, which model will work. I think everything will coexist provided there's a value for the end customer.
This reminds me of the language I've heard you speak right since 2000, that the opportunity is much bigger than getting into micro nuances. Let's convert savers into investors first. And I think I would just like to summarize by saying that these are buzzwords. Every cycle there are new buzzwords and new themes which will come in. But the reality is technology is a part of life. And the sooner we adopt, the sooner we embrace, because consumers are getting digital. Every part of their life is getting digital. So the opportunity for this audience is to see how can they align with technology, how can they align with these newer trends and participate along with it and expand the pie. So I think the game is very clear. We still have 7-8% penetration. If 6 crore households, as you said, investors can be potential, what we have touched right now is just 1 crore. So there's a much larger pool. Cost of reaching them is what technology can help in bringing it down. Experience can be far better. Mobile apps-led conversations can help in making a better impact versus paper-based conversations that we are doing. So with that, I'll just thank the panelists.